Hello and welcome to Future Investor UK. Today I'm going to be talking about the magic of investing in your 20s. The best time to start investing is as early as possible, and if you've got money to spare, it can really be beneficial in the long term. This is through the magic of something called compounding. I'm going to try and explain this in basic form in an analogy about apple trees. So let's see if this makes sense. If I had one apple which I plant and it grows into an apple tree, that apple tree then grows two apples, which then I can plant both those apples and they both grow into apple trees which produce two apples each. So I've got four apples which I can plant. That grows into four apple trees, each of which produce two apples. So then I have 8 apples and I can plant and grow 8 apple trees, and so on and so on and so on. And that's kind of the example, a very basic example of kind of an exponential growth curve that you kind of get from compounding, where over time your base amount continues to increase and rapidly get bigger and bigger and bigger because it's increasing over time. And the same thing kind of happens in the stock market, where your initial investment, so let's say £100, maybe grows by 10% in 1 year. And so after 1 year, you've got £110. Well, in the second year, if that same investment was to grow 10% again, it's actually growing 10% on top of that £110. And so you're not increasing it by £10 again, you're increasing it by 10% of £110, so you're increasing it by £11. And over time, that gets more and more and more as time goes on and you compound more and more in the stock market. And that's why compounding graphs tend to look like exponential graphs, because the longer you're invested, the kind of steeper that compounding occurs. And so you're increasing it more and more by not just your initial investment, but by the compounded gains that you've been getting over the years, if that makes sense. And so it's a really beneficial way of kind of increasing your money, and it's really looks like magic, but it requires lots of time to work properly. And that's why on this channel I promote long-term investing, where you can let compounding do the work rather than trying to do high-risk investing where you're looking for 100% gain in 1 year. If you just kind of go with an average flow of the stock market, looking for like 6, 7, 8% a year over a span of 30 years, that's going to have pretty massive gains through compound interest. But it takes time, and a lot of people don't want to, take that time. But if you start young, you've got plenty of time to kind of try and invest properly, safely, and reap the rewards when you're older. I'm now going to talk about some compounding cash examples. So if I invested £1,000 at 8%, in 5 years, that would be £1,489. In 10 years, it would actually be £2,220. In 20 years, it'd be £4,926. In 40 years, it would have become £23,273. And if I left that £1,000 compound for 100 years at 8% interest, it would be £2.9 million. And that was just £1,000. I haven't added any more money to it. I've just set 8% every year that it's been growing. And because of the compounding, because you're getting 8% on top of previous year's 8%, over time, that grows and grows and grows, and you end up getting that massive 2.9 million figure from just £1,000 if you left it for a long enough time. And you're unlikely to be investing for 100 years, but you might be investing for 30, 40 years. And even with that 40-year timeline I just spoke about, where your £1,000 becomes £23,000 over those 40 years, that's a very large gain. And so if you've got the time and you've got the patience, you can reap massive rewards through this compounding. And that's why it's so important and so magical to start investing when you're young. And that leads me to just quickly talk about the importance of time horizons on investing. If you invested £1,000 when you're 20 and you withdrew it when you were 50, average, increase each year in the stock market was 8%, it would now be worth £10,900. So in the space of those 30 years, your £1,000 has grown to be £10,935. That means each pound you initially invested is now worth £11 at 50. To reach that same amount, so £10,935, if you started investing at 40, you'd actually have to invest £4,950 at 40 to get the same amount, £10,900 at 50. And this means every pound you're investing then only grows to become £2.2. And that's really helps show how important investing young is, and it shows how much each pound is worth in terms of how much it's going to grow over those time spans. And it shows that even if you don't have as much money now, older people like to be on higher incomes and able to invest more. Even investing a couple of £100, now really makes the difference when you're older, when you start withdrawing that money, because it's going to have had time to grow a lot more. I'm also going to talk about the magic of continually investing over time, over a long period of time. So in my previous examples, I've used a fixed £1,000, which has then grown over time to easily illustrate how the compounding effect works. In this example, I'm going to talk about if you took that base £1,000, but then also over a certain time period, added in every year certain amounts of other money. So for example, if you continually invested over 30 years with an initial investment of £1,000, and then you invest £1,000 a year, your total input amount is £31,000. So over 30 years, you've invested £31,000. However, after 30 years of compounding, this could now be worth around £130,000 at 8% interest. And so you've made, £99,000 essentially through compounding effect over those 30 years. Meanwhile, if you started investing later, so you only invest for 10 years, so you invest from 40 to 50, let's say, but you increase your yearly deposits to £3,000, so you're depositing that same 30 grand over the shorter time period, and you have an interest, and you have a compounding gain of 8% a year. That same amount, so that same £31,000 that you're depositing, only becomes £46,000 by the time you're 50 and you want to withdraw it. So that really highlights how, even investing less each year really ends up making more in the long term if you've got that longer time horizon. And I hope all the examples I've talked about have really stressed home how useful, having time on your side is in terms of having the longest possible time horizon. And that really makes, investing any amount you possibly can beneficial, and investing in safe investments, long-term investments that are likely to have, a return over a long period of time. And then you can reap those rewards when you're older. I hope that's been a really insightful and kind of thoughtful example and discussion around how, compounding of investments and can really help build your wealth over the long term, and how important it is when you're younger and how beneficial it is when you're younger. That's part of the reason I set up this channel, really, is if you can start investing when you're younger, you'll really see the benefits of that when you're older. And investing, any possible money you can have is really beneficial. If you found this video useful, please like and subscribe, and leave a comment if you want any questions that you want to discuss or something that's not clear from this video, and I'll get back to you as soon as possible. Till next time, thank you.